For more on this, Stephen Nash joins me from FIIG Securities in the studio today. Stephen, good to have you in. Obviously some figures coming out of Spain, everyone's watching them, and also we had the downgrade from Fitch on Spain. How great a concern is all of this?
Well, I think normally it wouldn't be as much as a concern it is now, because there's a general focus on finances in the European Union at the moment, and with this downgrade it's not what the market really wants to hear. It's not, in terms of overall rating for Spain, it's not really a problem in terms of, it's still very high rating, but the market's concerned about the impact of the fiscal tightenings and increases in banking costs will be passed on to consumers and then lead to some contraction in the economy. I think consumer confidence...
So it's that feedback into consumer confidence. Consumer
confidence is starting to be affected, and the fiscal consolidation is going to be quite severe there. So the markets at the moment are trying to assess how much this is going to impact growth. And the question is, will it be a shallow recession or a more severe recession? I think the market will move between those two ideas over the next few months, and we won't see a conclusion for a while.
And the question seems to be in the market is whether China's strength can offset any weakness that comes out of Europe. There seem to be two camps. Either you believe that, China's going to offset that, or you think that there's going to be some sort of contagion effect and the banking system will become infected again. Yeah,
to some extent the Chinese have been trying to shift from the export sector back to domestic consumption, but that's not an easy thing to do. And we don't expect that China will be completely immune from the effects of the global recession. Hopefully it will be avoided, but Europe could be leading us back into that, and China won't be completely immune from that.
How long can this negative sentiment last, do you think?
I think we're looking towards the third quarter where there could be some sort of resolution around that time, but I think the market...
Why then?
I think the market just needs a few months to assess what the severity of the recession in Europe will be. It's a very important question. Can't be answered immediately. We'll have to see how far consumer confidence falls. There is some signs of growth in the North American economy, and maybe those signs will become clearer by the end of the year. I think that's what's basically going to happen. We'll have the hard growth from the US coming through, and the concerns about Europe hopefully will fade by that time, but we're in this period of assessing that right now.
Australia likes to think that we're mostly immune and very removed from what's happening in Europe. Do you think we're taking these risks seriously enough in Australia?
I think generally, I think Australian economists are probably not taking it seriously enough, and that they think that rate rises will start again around the September quarter. I imagine that we'll probably go through a fairly rough patch before that, and that rate rises will probably be delayed until 2011.
Okay, because I mean it was interesting when we had the RBA statement a couple of days ago. They spent basically one paragraph talking about Australia, 3 on the overseas picture, which is quite a shift from what we've been seeing from the Reserve Bank of Australia. How serious do you think the RBA is judging this issue from what we saw out of that statement?
I think they're reassessing the domestic economy right now. They're remaining fairly quiet on that. As you say, the silence is deafening almost,
Well, they didn't really talk about consumer spending, the labour market or housing.
No. And they have in the past. So I imagine there's a re-evaluation going on there. Auction clearance rates have come off substantially. Why is that? Well, I think partly because of rate rises, but also I think consumers are aware of the global situation, and another recession would not see consumers that are highly exposed to loans well off. So people are basically being more conservative.
So do you have questions about what the RBA is thinking on the domestic situation, do you? Because I mean the RBA statement doesn't exist in isolation. We get almost every week or every other week we get an RBA board member or an official speaking and communicating to the market, and they've made great efforts to be very transparent.
Like there's a little bit of a change going on. The language is starting to moderate a little bit. They were characterising the housing market as buoyant. They've been fairly silent on that in recent announcements, and I imagine that the language will continue to change and recognise that the changes that are occurring in the economy at this stage. There's also been a slight rise or a trend up in delinquencies, in mortgage delinquencies over the last quarter or so. The trend itself is the thing to watch, and the trend is up. But the data that we have is not covering the whole system, so it's a little bit difficult to have any definitive statement on that. But the trend is not down, it's up.
And you think there was some sort of message in there then about just steady rates for a little while at least? I mean, what's the market pricing in at the moment?
The market's looking at steady rates out till about the end of the year, and then rate increases after that. That will move around depending on what happens with perceptions of growth in Europe, and I think that those concerns could intensify towards the September quarter.
And so, Stephen, just finally with the GDP numbers as well yesterday, which added to the picture that we're getting about the domestic economy, there was a worry from some that maybe public spending is the only thing really supporting the economy at the moment. Maybe it looks weak, you know, when you take that away. Were there any surprises in there for you, or any particular important areas of the GDP numbers?
I would have expected probably private sector consumption to be a little bit higher than it was. And if the economy is now moving into a lower growth situation, then maybe that's going to be even weaker going forward. There was a revision up in the previous quarter, so the market overall saw that the figures were a little bit firm and then sold off a little bit. But yeah, I would have expected private sector consumption to be a little bit firmer than it was, so that was a bit of a surprise to me.
Stephen Nash, we have to leave there for today, but thank you so much for your time.
Thanks very much.
Always good to get the thoughts of FIIG Securities. There's Stephen Nash joining us in the